Hello and welcome everyone to the latest in our Pulse Advisor webinar series. My name is Rob Montague. I'm one of the team of international sales managers at Novia Global. And today we're delighted to welcome back and have join us Will Riley from Guinness Global Investors. Will's been running energy portfolios for over 15 years now and is portfolio manager for the Guinness Global Energy and Sustainable Energy funds. The last session we ran with Will was had one of the highest attendee levels and participation rates. So he's back by popular demand to give us an update into energy investing. He'll be looking at both the conventional and renewable sources and providing us insight into the evolution and transition within the energy market. The session will run for around about 35 minutes and we will have time for questions at the end. If you would like to submit a question, you can use the Q&A button on your screen. Like I say, we'll try and get through those at the end. And if we overrun, we will get back to you with those answers. So without further delay, I will hand over to Will.
Rob, thank you very much. And many thanks to Novia for hosting me again. So as Rob was saying there, the ambition for this morning's session is to explore this topic of energy transition. I was last chatting on this forum 7 or 8 months ago, and as ever, the world of energy and transition has been extremely busy. Lots to talk about in the context of the Russia-Ukraine crisis, what's going on in China, the strides that the US is making in terms of renewable investment. So we're going to explore all of that, thinking about what that means for energy transition, what it means for oil and gas prices, for renewable energy, and then how we can invest in those themes via the two vehicles that Rob just described, our Global Energy Fund that focuses on oil and gas, and our Sustainable Energy Fund that focuses on renewable energy and efficiency. So let's get straight into it. And I'm going to start with a kind of reminder, big picture of where the world is in terms of its energy consumption and where it's heading. So big picture, still we have a world dominated by hydrocarbons, oil, gas and coal. They still make up about 83% of world energy demand, the other 17% being nuclear and renewables. And if you look at the renewable portion, it's still just over half hydro, so old-fashioned renewables. And that means that technologies like wind and solar and geothermal, for all the growth and the build-out we've had in the last 5 or 6 years, there's still a pretty small part of the picture. They're still only about 5 or 6%. So there's a long way to go here. I think the other notable point is just how rapidly the energy system has grown over the last 30 years, up about 75%. And it's going to be very difficult to repeat that growth rate over the next 30 years. Looking ahead, again, big picture, where do we see the world in 2050? And I think like any long-term forecast, take this with a pinch of salt. But directionally, we think that very soon coal will be in terminal decline. Enjoying a little bit of a bounce and renaissance because of the Russia-Ukraine crisis, but ultimately that goes into terminal decline. Very little coal being used in power by, say, 2040. Oil and gas still have, I think, a pretty viable life, and we'll come on to that. And really, this is all about the growing wedge of green. So the growing wedge of variable renewables, wind and solar, by the middle of this century becoming about half of the world's energy system. Just a word on nuclear. I think since I last presented on this forum, nuclear has had a lot more focus, a lot more positive focus as part of the low carbon solution. And I think things are changing a little bit there. I still don't think it's going to become a dominant part of the mix by 2040, 2050, but certainly there's a bit of a turnaround there. And that's also something we'll explore in a few minutes' time. If we think about why this transition, this energy transition is occurring towards renewables, for the last couple of years, really the focus has been on the second reason on this list, which is climate change and decarbonisation. If you think about all of the post-COVID stimulus coming through in Europe, Asia and the US over the last 2 years, particularly 2020 and 21, that was driven, the key catalyst there was the drive towards cleaner energy to decarbonise. And that reason, of course, hasn't gone away. But the last 12 months, the focus has been much more on energy security. So that Russia-Ukraine crisis putting a spotlight on the fact that Europe, for example, is a major net importer of energy. And that is a dangerous position to be in politically and economically. And Europe is waking up to the idea now that it needs to wean itself off Russian oil, Russian coal, and Russian natural gas really as fast as it can. And the great advantage of sustainable or renewable energy is that it tends to be localized and distributed. So once you've built out a renewable energy system, you're no longer relying on energy imports. So I think if we're being cynical about this transition, that energy security driver is actually going to push things quite a lot faster than climate change, for those political and economic reasons, which I think are quite clear. We also emphasize that the energy transition is occurring because of economics. The simple fact that onshore wind, offshore wind, and solar are now cheaper technologies than incumbent fossil fuel power sources, i.e. if you're trying to build out a large gas utility or coal utility or even nuclear, those technologies are now undercut to quite a significant degree by renewable technologies. And renewables over the last few months, they haven't been immune from inflation. They are ultimately, the companies in the sector are manufacturing companies, and input costs has been rising. But the important point here is that the relative economics of renewables have improved over the last 12 months. Because power prices driven by gas and coal have gone up so much, even though solar and wind have gone up a little bit, on a relative basis, they have become more attractive. And just one other bigger picture point before we then dive into the other side of oil and gas. I think I touched on this 6 or 7 months ago. The change that we've seen really since the end of 2021 is the world now moving into a structural energy deficit for the first time in the last 30 odd years. Since 1990, more or less energy demand and supply, and this is thinking about supply across the board, hydrocarbons, nuclear, renewables all combined, they've been in pretty good balance. But we saw at the start of 2022, the world moving into a deficit. And this is caused by underinvestment in hydrocarbons, coming at a time when renewables are growing fast but can't fully fill the gap. And that deficit, which last year looked to be about 2%, on sort of credible forecasts grows to about 8% by the end of the decade. And this means that although energy prices will continue to be volatile, on average, we think they're going to be bumping up against the price that causes demand destruction, i.e. the price that's necessary to close the gap that you can see on this chart. So if you're translating that view into your portfolios, for a lot of the last decade, it was quite easy to be underweight energy. But I think for this decade, you need to think about that position quite carefully. We are going to have higher average energy prices, and that's going to be positive for energy equities across the board, whether it's oil and gas or on the sustainable side. Let's explore then the world of oil and gas a little bit further. And here on page 10, we've got a chart of the spot oil price. And as ever, over the last few months, it's been extremely volatile. The middle of last year, we got up to about $120 a barrel. And today we sit with an oil price somewhere in the low to mid 80s. And just to think about what's been going on over the second half of last year and into the start of this year, we got to a level last year at about $115, $120 that was consistent with the red line on this graph, which is the estimated demand destruction level. So it's a price that starts to cause consumption of oil to fall because it's simply getting too expensive for some parts of the world. And in particular, that was over in Asia, where in local currency terms, oil was even more expensive than this chart, which is in US dollars. So you had a bit of demand weakness as a result of that. You also had China continuing to pursue its zero COVID policy in the second half of last year, and that was a dampener to demand as well. And we had more resilience in some parts of supply, particularly from Russia. And all of that helped the oil price moderate down to this level of around $80, $85. And that price is consistent with the blue line on this chart, which is what we call the incentive price for new supply. It's the level for oil that we think brings on enough supply to meet demand in the medium term, let's say over the next 3 to 5 years. So when we come on and talk about kind of energy equity valuations, we have in our mind an oil price of plus or minus 80 as a long-term price. If we then look at what's happened to oil demand, and a reminder, first of all, just how severe the demand destruction was in the COVID year of 2020. So demand down about 9 million barrels a day on average. Bear in mind, the oil market is a market of about 100 million barrels a day. So 9 million is 9%. We've now, going into 23, fully recovered that loss. So it was really by the end of 22 that we'd created that full recovery. And so 23 will be the first year of kind of record demand above and beyond 2019. And if we think about the key drivers for oil this year, what are for oil demand, the key variables? I think that there are two things in particular that I'll point to. The first is Chinese demand. So last year, with that zero COVID policy being pursued, China's average oil demand was down by about 500,000 barrels. That was the first annual decline from China since 1983. So that was pretty significant as a kind of oil macro event. As China opens up, we're going to see continued weakness in the short term as that COVID wave passes through. But beyond that, we can see about 2 million barrels coming back from China as it gets back onto its kind of normalized post-COVID path. So that is going to be a significant tailwind for oil. The other tailwind is global aviation, which is also still normalizing, even in the West, from COVID, from pre-COVID highs. And you simply have to look at flight schedules around the world that have been laid out for the next 6 to 9 months, and you can see that recovery coming through. That's the yellow line on this chart on page 13. Oil will follow on, and that's another 1.5 to 2 million barrels. So add that together with China, and there is significant impetus coming through for oil demand, despite the GDP slowdown that we have in the West. Just a word on the affordability of oil from a macro perspective. This year, if we have oil averaging $75 or $80, the world will be paying about 3% of GDP for its oil. Even last year at $100, that was 4% of GDP. And comparing to history over the last 50 years, that's perfectly affordable. So the good news is we don't think that oil currently, or even a little bit higher at $100, is a stress on the world economy. Worse news, however, is that if you combine oil with natural gas and coal and renewables, so the total energy cost as a percentage of GDP, that is still expensive. That's still over 10% of GDP this year, up similar to the level that we had in the early 1980s. And that is one of the key contributors to kind of global recession. And a reminder that this is a much more severe situation for Europe and Asia that have a much higher natural gas price, still, even with a bit of relief recently, up at about $20 an MCF, whereas the US currently has a gas price of more like $3 or $4. So that very significant differential means that I think the US has a much easier time this year economically than Europe. When we're thinking about oil demand long term, we're constantly thinking about the battle between plug and pump. In other words, the rise of electric vehicles and what that is going to do to oil demand over the next sort of 5, 10, 20 years. It was a very strong year for EV sales last year, about 10 million electric vehicles sold around the world. That's about 13% of the light auto market. And that keeps us, we think, bang on target for the green line here on this chart. That's the growth in the population of EVs. We think that by the end of the decade, about 50% of cars being sold will be electric, and pretty much all cars being sold by 2040 will be electric. When we're thinking about that in terms of oil demand, though, just a reminder that light autos, passenger transportation, accounts for about 25% of overall oil demand. The other 75% is heavier types of transportation, it's petrochemicals, industry, power. A lot of those other factors do, or those other sources of oil demand do face a substitution threat, but over a much longer time scale. And when we put all these kind of pieces of the jigsaw together, yes, on the one hand, we do think that light auto oil demand will peak in the next couple of years, but overall oil demand probably doesn't peak until about 2030. And then the runoff from there is actually pretty shallow. And it means that in 2040 or 2050, we're still going to be consuming as much oil as we were in the 2000s. So if you're thinking about this from the perspective of owning oil equities, there is plenty of life here to go. On the supply side for oil, we tend to think about supply in 3 key buckets. We think about non-OPEC outside the US. We think about then the US onshore shale system. That's the part of the market here in red that grew very rapidly in the last decade and caused OPEC significant headaches in terms of oversupply. And then you have OPEC, about 40% of the market in the middle of this table, still being led by Saudi, and trying to referee the overall situation and create a balanced oil market. Just a couple of slides on this. If we think about the non-OPEC world, typically this is a world where when you have high oil prices, you have high levels of capex and growth, and that tends to reset the cycle. But currently we're going through something rather different. We've seen quite a sharp drop-off in oil capex around the world, and that's shown by the blue line on this chart. And you can see that despite the post-COVID recovery in oil prices that we've had over the last 2 years, capex has gone nowhere. So this is driven by a change in behavior from the participants in this market. It's ESG pressures in the West. It's European oil companies having to pursue a low carbon future. It's US shale companies realizing that actually if they pursue capital discipline as opposed to growth, actually they can have a higher oil price and higher return. So all of those things keeping non-OPEC supply relatively muted, and that is music to the ears of OPEC, who can keep control of the market. And if you think about, at the heart of OPEC, if you think about Saudi's ambitions, Saudi have a fiscal break-even oil price this year of about $75. So what do we mean by that? That's the oil price that Saudi needs to balance government revenues with government spending. And historically, this tends to be revised a little bit higher. So I wouldn't be surprised if it was more like $80 this year. That's what Saudi have in mind. I think Saudi would be perfectly satisfied with an oil price, let's say, of anywhere kind of 75 to 95. If it drops much below that level, then they will step in with their OPEC and OPEC plus partners to balance the market. One of the key variables in terms of supply is, of course, Russia and how supply evolves from here, given the ongoing war with Ukraine. Going back to the middle of last year, and agencies like the IEA, the International Energy Agency, were overly bearish on how sharply Russian oil supply would fall as a result of that crisis. The IEA were forecasting a decline of about 3 million barrels. And we always thought that was overly pessimistic. We always thought that there was a really reasonable chance that Russia would be able to divert cargoes that had been being sold into Europe and US. They'd be able to divert those east into countries like China and India. And indeed, that's what's come to pass. Things do get more complicated as of next month. So the EU now has an embargo on Russian oil imports, and as of next month, an embargo on Russian oil product imports. So imports of refined products like gasoline and diesel, and some of those will be more difficult to divert to new markets. So we do think Russian supply comes down from here, but as I say, not nearly as much as the market previously anticipated. One of the reasons for that, just looking at interestingly the market for so-called ice class oil tankers, this market went kind of crazy. In the second half of last year, we saw sales of these types of vessels up 5 times on the previous year, costs doubled. And this is all about Russia lining up a fleet of ice class tankers on their north coast to then take oil around the north coast of Russia and down into China and the rest of Southeast Asia. So Russia obviously working hard to resolve the situation. Just a word on natural gas prices. As I mentioned before, very, very different regional markets. We've had extremely high natural gas prices in Europe and Asia, so the green and the blue lines on this chart, over the last 12 to 18 months, whereas the US gas price has come up a little bit, but nothing like as much. And the battle for Europe over the second half of last year was trying to replace Russian imports with other sources of gas to make sure that the lights could stay on through this winter. And Europe was very successful in that, mainly through the device of pulling in imports of LNG from places like the US and Qatar, but that came at a cost. It came at a very high price, prices up at about $30 or $40 an MCF. So Europe has gone into this winter actually well supplied with gas, and the relatively mild conditions that we've had in Europe have been an absolute saviour. And it means that we'll come out of this winter still in a pretty good position, because we have to look again to next winter. If we have very little Russian gas imports through 2023, we're going to be even more reliant in Europe on Norwegian pipeline gas, Azerbaijan gas, and global LNG. And in particular, that global LNG market is going to be tighter this year with China opening up. They are going to be competing with Europe much more so than they were last year. So a bit of relief in the short term, but we still have a gas price at about $20 an MCF. That's about 3 times higher than it was in 2019. So some relief, but still gas at a very elevated level. Thinking about then how we invest on the oil and gas side, and a couple of slides, kind of bigger picture for energy equity valuations. So here on page 28, we can see the price to book of energy in red versus the S&P in blue. And I like this chart because it goes back to the mid-1960s. So it's a good long sweep of history. And you can see that energy got right down in 2020 to a price to book of about 1 times. That matched the low of the late 1970s, early 80s. Since then, the last couple of years, energy has outperformed up. So the price to book now up from 1 to 2 times, but still very significantly dislocated from the S&P 500, where the price to book is more like 4 times. So on a relative basis, energy is still about 2 standard deviations away from the long-term relationship. There's still some very good relative value here. Another way to make that value argument is this chart here on 29. This is showing a correlation between price to book and return on capital for our current portfolio projected back over the last 22 years, back to 2000. And there's a very high correlation here, i.e. if return on capital in the sector goes up, the price to book goes up. So the market does care about this relationship. But you can see circled in red there where we are for 2022, 23 and 24. There is a major dislocation from the line. I think the market is still skeptical about the longevity of higher oil prices. Actually, though, if these companies can return 10 or 12%, which we think they will comfortably over the next few years, that price to book for our portfolio should be re-rating from about 1.5 times today up to about 2.1, 2.2 times. So there's an uplift still of kind of 40, 50 or even 60% to come through. One of the good news, one of the sort of good pieces of news as an investor in the sector or our portfolio is that you are being paid to wait. You are being paid via very handsome free cash flow yields. So at the start of this year, looking ahead, assuming an $80 Brent price, looking at some of the major positions in our fund, an average free cash flow yield of just over 12%. And if we look at how we're positioned in this fund, we've got a pretty good spread across mid and large cap integrateds, making up about 50% of the fund. We've got about 20% pointing towards the US shale system, mainly focused on the Permian. We've got some refining pure plays in companies like Valero, Sinopec. We've got a decent weighting towards service companies with oil and gas spending starting to creep up a little bit, particularly in the Middle East. And we've got some pure play international gas focus. So that's a portfolio trading on a price earnings ratio this year of about 8 times. And this is a fund up over the last 2 years by around 90% versus MSCI World flat. So there's been good outperformance, and we think that can continue. Moving then back to the world of sustainable energy and thinking about the key drivers for this fund, the outlook over the next year and beyond. So a reminder, what's driving this fund? It's the growing wedge of green, the growing wedge of renewables, and it's also energy efficiency. The fact that if we carry on with kind of business as usual, we'd be on the demand line shown here by the dotted black, and that's unsustainable. We've got to come down from there, and we need more energy efficiency measures, things like electric vehicles replacing gasoline, heat pumps, insulation, etc. So that's a key part of our universe, investment universe, as well as solar and wind. If we look firstly about how solar is growing, solar now the cheapest form of electricity in the world, we're up to about 300 gigawatts of installations this year. Bear in mind, it was only 2 or 3 years ago, we were at about 150. So this market has doubled. Solar is growing very, very rapidly indeed. And we think we get up to an installation rate of more like 600 or 700 gigawatts by the end of the decade. If we look at what's happening in Europe, think about those comments I was making about energy security and how fast Europe is going to try and replace Russian gas. You can see it here in terms of imports of Chinese solar PV modules into Europe, running by the middle of last year at about 2.5 times the level that we saw in the middle of 2021. So this really is happening. On the wind side, wind growth has been a little bit more muted in the last couple of years. So wind growing at about 100 gigawatts a year at the moment versus solar at 300. But we think there has to be a major acceleration here if the world is to keep up with its decarbonisation targets. So we think that wind by the end of the decade will be something like 200 to 250 gigawatts. And if you look around the world, we've seen onshore wind growing now to turbines of size about 150 meters, and the focus is now more on offshore wind for growth. The turbines there, if you look at Vestas's latest offering at about 260 meters, that's up at kind of Eiffel Tower scale, and these larger turbines driving a kind of a major shift in terms of the amount of power coming from that sector. If we look at electric vehicles, as I mentioned a moment ago, in the context of oil demand, electric vehicles having something of a banner year in 2022, 10 million units being sold. And the main driver of that growth last year was China. China accounting for about 60% of the market. Europe a little bit slower, but I think starting to accelerate again this year. So in 2023, we think we're going to see sales of about 13 million units, i.e. electric vehicles. That's about 15% of the light auto market. And that has various positive implications for our portfolio, in particular for the companies we own that manufacture lithium-ion batteries that go into EVs. A pretty rapid growth rate. This year, we're expecting about 400 gigawatt hours of battery capacity to be built out around the world. That grows 50% just by 2025. In terms of kind of policy, the really big news since I last chatted in this forum came in late July last year with the introduction of the Inflation Reduction Act and the climate portion of that act, around $300 billion, pointing across the breadth of the energy transition, and the US making a really concerted effort to onshore renewable manufacturing technologies away from China in particular and bringing them back to the US. And that really does mean a step change in terms of the amount of power capacity, and in particular renewable power capacity being installed in the US. And you can see that on this chart. This is an analysis from Princeton University. Historically, over the last 50, 60, 70 years, on average, maybe 20 or 30 gigawatts each year of new capacity being installed. And we're going to move up to more like 100 to 150 gigawatts on average. So a really big change coming through there. Thinking globally, over the next 5 years, we're expecting installations around the world now of about 2,500 gigawatts of renewables. That is double the rate that we saw in the previous 5-year period, 2016 to 2021. Just a reminder, though, of the kind of big picture point about net zero. Everything I've been describing here is a very positive Guinness base case, but it doesn't get us to net zero. It doesn't get us even close to 1.5 degree of warming. If governments around the world continue to pursue that agenda, which we think they will, then it means solar, wind efficiency going even faster, and overall energy investment towards the transition needing to be about $4.5 trillion a year versus about $2 trillion currently. Many topics here. Just a word also on nuclear. Nuclear kind of deserves its own session. There's a lot going on here, but we are seeing that positive kind of step change in sentiment towards nuclear, people realizing that it can be part of the low carbon solution, providing so-called baseload power, whereas wind and solar provide variable power. So they're all going to be part of the mix. But we continue to have the problem that a lot of the existing nuclear capacity around the world was built out in the 70s and 80s, so it's coming to the end of its useful economic life. Look, therefore, at a country like the UK, with Hinkley Point coming on in the late 2020s, still, even with that very rapid expansion, net nuclear capacity in the UK by the end of this decade will be down because of retirements in other parts of the country. So that's the challenge. Thinking finally about how we're investing on this side of the transition in our Sustainable Energy Fund. For those who don't know it so well, this is under EU SFDR and Article 9 fund, well aligned with some of the UN Sustainable Development Goals, in particular affordable and clean energy and climate action. And if we look at how this portfolio is currently positioned, we're pretty well spread across the breadth of of transition. We've got about 20% of the fund in what we call electrification of the energy mix. Those are the companies owning and operating the renewable generation assets. Sonova, for example, is US rooftop solar. Nextera is the US's largest green utility. We've then got about 29% of the fund pointing towards the growth of electric vehicles. So that's EV component supply chain names like Sensata and Aptiv. And then it's the battery manufacturers like Samsung SDI and LG Chem. We've then got about 8 or so percent in the wind chain. We've got 16% in solar currently. So up and down the different wind and solar supply chains, about 15% in efficiency, and then 1 position in geothermal. And just one observation about the performance of this fund, it outperformed MSCI World by about 6% last year. We saw a lot of M&A. We saw more M&A than I've seen in the 15 years that I've been doing this. And that was across the board. We saw Hella being taken out, that's German EV components. We saw Albioma, which is French biomass, and we saw Siemens Gamesa being bought by its parent company. So a lot of good activity going on here. And overall, the performance of this fund over the last 3 years, the fund up around 77% versus MSCI World up about 16%. So again, some good outperformance coming through there. A final word on this portfolio. We also think about the positive impact of the companies that we own in this portfolio. We published our latest impact report towards the end of last year. And the key finding, the headline finding, is that $1 million of assets invested in this portfolio displaced around 650 tons of CO2. And if we look at company by company, the average company was up about 14% on the previous year. So this is a check on the companies that we own in this portfolio are moving in the right direction in terms of displacing carbon. So I will wrap up there. I think that the simple conclusion from all of that, we are now in a world of structural energy deficit. We need greater investment across the breadth of the energy market, still in oil and gas in the short term, and also on the transition side. And as hopefully I've made clear, we've got our Global Energy Fund, which provides you access on the oil and gas side, and Sustainable Energy, which gives good exposure on the transition side. So with that, I will pause, hand back to Rob.
Thank you very much indeed, Will. Yeah, very insightful, very helpful. And we have had quite a few questions coming in, so if I could go straight to those. Yeah, I like this one from Chris. Have you factored in the work by Professor Simon Michaud on behalf of Finland's Geological Society? He's reported that the EU, UK known deposits of metals make up only 3 to 20% of what's needed for energy transition. So basically looking at restrictions and difficulties in mining technology.
So I think if you look on a global scale, the metals are there, broadly speaking. I mean, we can, I think that comment's true for copper, nickel, lithium. The lithium is there as a raw material. It's a question of refining capacity. So there will be bottlenecks in this. There will be bumps in the road. But I think that question really is more directed towards the concept of kind of energy security. The idea that if Europe and the US are going to build out renewable energy and electric vehicles, then a lot of those metals and those supply chains are coming from China. And you know, what can the West do about that? I think part of the solution is higher prices. You know, rare earths, for example, which are critical in a lot of these technologies. Europe and the US simply haven't looked for them because they haven't needed them. And just in the last couple of months, we've seen a very substantial rare earth deposit being discovered in Sweden, for example. So I think I don't want to underplay the challenges, but I think things will improve. But yeah, for in the shorter term, there is a reliance on China, and this, by the way, is one of the things that the US is trying to solve with the Inflation Reduction Act. That have very significant tax incentives to bring to onshore manufacturing facilities, and also bring some of that metals mining back to the US as well.
Okay, and just with your mention of the Inflation Reduction Act, obviously there's been a bit in the news about a sort of spat between perhaps Europe and the US, and perhaps Europe looking to loosen some of their restrictions on subsidies, etc. Is that all positive for the industry, or in increasing the amount of companies in this market, or are there any problems with this?
Ultimately, it's a positive. I mean, you're absolutely right, Rob. So what we've seen is Europe are looking at those tax incentives that the US has rolled out, and a lot of even European renewable companies or global companies are currently shifting all of their investment plans to the US because they're getting much better terms over there. And Europe is squealing. We saw this at Davos over the last 2 or 3 weeks, saying this isn't fair. And I think Europe is quickly waking up to the fact that either they try and match the provisions of the IRA, or they're going to be left behind. There's no point in trying to slow the US down. That's not going to work. So ultimately, we're expecting over the next few months Europe to roll out its equivalent to the Inflation Reduction Act. It's got some of the way with the Repower EU deal, but there'll be more tax provisions coming out, tax subsidies and incentives coming out this year. So yeah, overall, that's going to allow Europe also to accelerate.
Okay, thank you. We've had a few questions along similar lines. So with the increasing shift to renewable power and the intermittency problems and frequency, where do you see utility scale storage solutions coming from? Electrolysis, for example, and battery storage, etc.
Yeah, so it's a really important question. If you look at a typical grid, a typical country, then the rule of thumb is you can get up to about 30% of power coming from variable renewables like wind and solar without the need for storage, i.e. 30% can be blended in, with other sources quite successfully. Beyond that, you start to need storage, and you can get up to about 60% wind and solar if you have viable storage. At the moment, we've got batteries and pumped hydro as the main two solutions. Batteries are now being rolled out at utility scale. Initially over the last few years, it's been more at the kind of residential scale, but now it's coming through at utility scale. But even at the utility scale, batteries they give you cover for 3 or 4 days. They don't give you seasonal cover. So ultimately, this is probably where hydrogen comes in. So that the build out of a system of electrolyzers and fuel cells to develop hydrogen as a form of storage for renewable power. The idea is you're using excess renewable power capacity when it's very cheap to drive your electrolyzers to generate hydrogen, and then convert that back into power when it's needed. That will be part of the solution as well. But this is all good reason why we also need efficiency. That renewable solar and wind will only get us so far. We need a bit of nuclear in the mix as well as base load. But yes, storage is one of the key solutions at utility scale, still to evolve over the next 10 or 20 years.
Okay. Perhaps just looking at your own funds, if a client were to allocate a weighting towards energy within their portfolio, obviously the performance profiles of global energy and sustainable energy are quite different. If you looked at perhaps today, 5 years and 10 years, how would you see the weighting sort of moving between those if you're a typical investor?
You won't be too surprised. It's a question we get quite a lot, and it's a really difficult one to answer. I tactically, okay. Over a short time scale, I will give you an answer, but just on a short time scale, you know, the sort of macro drivers of oil and gas are relatively difficult to predict, i.e. what's going to happen in the next 3 or 6 months. So my boring answer is we tend to tell, you know, in my own pension it's 50-50, and I kind of rebalance over time. And I think that's a perfectly sensible answer on a kind of 5-year view. I think over that timescale, as I described, there's still a good value case for oil and gas. I think there's you know, a very good growth case still there, clearly for sustainable energy. Still on a 10-year view, the case for oil and gas is pretty good. I think if you're looking very long term, let's say on even a kind of 20 or 25-year view for your grandchildren, at some point probably oil and gas, you know, rolls off, and it's really all about the sustainable side. But I think in any kind of foreseeable investment horizon, both have good legs.
Okay, and perhaps just want to finish on, if there were to be an end to the war in Ukraine, either whether that's negotiated or Russia being driven out, what sort of impact would that have on the price of oil and gas, in your opinion?
I think for oil, I think there'll be a kind of relief, the opposite of a rally. There'll be a relief fall in both, in the short term. I think Europe would start to consume a little bit more Russian gas at the margin, but it wouldn't put Europe off its ambition now to become free of Russian gas structurally by the end of the decade. That isn't going to change. But in the short term, there'll be a little bit of relief. On the oil side, also a bit of relief. You'd probably see oil prices coming down sort of $5 to $10. But to kind of repeat why oil is already, you know, down in the 80s, it's because Russian supplies remain quite resilient. So even if Russia was kind of brought back into the global fold in some way, actually there isn't a huge amount of Russian oil to come back. So it doesn't cause any sort of price collapse. Okay,
excellent. Well, I think we're probably running to time now. So thank you ever so much for joining us again today. That was fascinating insight, really helpful. I'd just like to thank you and thank everyone for attending today as well. If you do have any more questions, please fire them through to us and we will pass them on to Will and the team to answer. Just a date for your diary as well. Our next Pulse webinar will be the 28th of February. The newsletter should be issued next week, so you'll be able to link into that. We'll be joined by Blue Whale Capital. And finally, just wish you all well and many thanks to Guinness again for putting this on. So thank you very much indeed. Goodbye.